You know what's fascinating? For the past few years, every time gold or silver pulled back even slightly, the financial media would rush to call it a buying opportunity or a sale. But something fundamental has shifted in the precious metals market, and most investors are completely missing it. The sale isn't just ending, it's already over. And the implications of what's happening right now are going to reshape wealth preservation for the next decade. Let me show you exactly what I mean, because the data tells a story that very few people are talking about. Central banks just completed their third consecutive year of purchasing over 1,000 tons of gold. Think about that for a moment. These are the institutions that literally create money, that have access to every financial instrument imaginable, and they're choosing to accumulate physical gold at a pace we haven't seen since the 1970s. They're not buying gold ETFs. They're not buying mining stocks. They're taking delivery of actual physical metal and storing it in their vaults. Now, why would they do that? These aren't emotional retail investors panicking about inflation. These are sophisticated institutions with teams of economists, access to classified economic data, and decades of experience managing national reserves. When they move in unison like this, they're seeing something in the global financial system that should make every investor pay attention. The World Gold Council's latest data shows something remarkable. Central bank gold purchases haven't just been consistent. They've been accelerating during price pullbacks. In other words, when gold temporarily dipped, these institutions weren't selling. They were buying more aggressively. That's not the behavior of institutions that think gold is overvalued. That's the behavior of institutions that believe they're getting the last chance to accumulate at reasonable prices. But here's where it gets really interesting. Let's talk about what's happening in the physical market versus the paper market, because this disconnect is creating a situation that's never existed before in modern financial history. The COMEX, which is the primary exchange for gold and silver futures in the United States, has been showing some extraordinary stress signals. Registered gold inventory, that's the gold actually available for delivery, has been declining while open interest has been increasing. What does that mean in plain English? More people are holding contracts that give them the right to demand physical delivery, but there's less physical gold available to deliver. Now, the COMEX has mechanisms to handle this. They can raise margin requirements, they can encourage cash settlement instead of physical delivery. They've done this before. But here's what's different this time. The buyers demanding physical delivery aren't speculators looking to flip contracts for a quick profit. They're sovereign wealth funds, central banks, and ultra-high net worth individuals who want the actual metal. I want you to imagine a scenario. Picture a game of musical chairs, but instead of chairs, it's physical gold bars. And instead of children playing a game, it's the world's most powerful financial institutions competing for a finite resource. The music is still playing, but everyone can see there aren't enough chairs. What happens when the music stops? This isn't theoretical. We saw a preview of this during the early days of the pandemic. Remember when gold futures were trading at significant premiums to spot prices? When you couldn't find physical gold coins or bars at any price? That was a temporary disruption in the supply chain. What's building now is something more structural, more permanent. Let's talk about silver for a moment because silver's situation is even more extreme. Silver has this unique characteristic where it's both a monetary metal and an industrial metal. About half of all silver mined gets used in industrial applications: solar panels, electronics, medical devices, electric vehicles. Unlike gold, most of that silver is consumed. It doesn't get recycled. It's gone. The solar industry alone is projected to consume massive amounts of silver over the next decade. Each solar panel requires about 20 grams of silver. As countries race to meet climate goals and transition to renewable energy, that industrial demand is becoming inelastic. They need the silver regardless of price. But here's the kicker. Silver mining production has been essentially flat for years. We're not discovering major new silver deposits. The easy-to-mine silver has already been extracted. What remains requires more energy, more capital, and more time to bring to market. So you have rising industrial demand meeting stagnant supply, and on top of that, you have investment demand from people who understand this supply-demand imbalance. Now I know what some of you might be thinking. But silver is still well below its all-time high from years ago. Doesn't that mean there's room for it to fall? That's exactly the kind of thinking that causes investors to miss major moves. Let me explain why that logic is flawed. When silver hit its previous peak, it was driven primarily by investment speculation. It was a momentum trade. People were buying because price was going up, and they wanted to ride the wave. That kind of rally is inherently unstable because it's based on sentiment, not fundamentals. When sentiment shifts, those rallies collapse. What's different now is that the foundation is fundamentally different. The investment demand is still there, but now you have this massive industrial demand component that didn't exist to the same degree before. You have central banks diversifying reserves. You have countries like China and Russia actively working to reduce dollar dependence. You have a generation of investors who watched the 2008 financial crisis and the pandemic response and concluded that holding assets outside the traditional financial system makes sense. These aren't temporary factors. These are structural shifts in how the global financial system operates. Let me tell you a story that illustrates what's really happening. There's a major gold refinery in Switzerland. I won't name it, but it's one of the largest in the world. They process gold from mines, from recycled jewelry, from central bank transactions. A few years ago, they noticed something unusual. They were receiving massive shipments of gold from Western vaults, London, New York, and immediately re-refining it and shipping it to Asia, China, India, Singapore. This wasn't a temporary flow. This was a persistent, one-way transfer of physical gold from west to east. The gold was leaving Western vaults and not coming back. Now, why does that matter? Because it represents a fundamental shift in where physical gold is being held and who controls it. Western financial institutions have historically operated on a fractional reserve basis with gold. They hold some physical gold, but they issue many more claims on that gold through various financial instruments. It's similar to how banks operate with deposits. This works fine as long as not everyone demands their gold at the same time. But Eastern buyers, particularly Chinese and Indian buyers, have a different philosophy. They want physical possession. They don't trust paper claims. They want the actual metal in their hands or in vaults they control. As more and more physical gold moves east, the Western fractional reserve system becomes more fragile. Here's where it connects to what's happening right now. The sale on precious metals, those periodic pullbacks that created buying opportunities, those were largely driven by paper market dynamics. Large institutions would sell futures contracts, driving down the paper price, and that would temporarily pressure the physical market. But each time that happened, physical buyers would step in and absorb the metal. The paper sellers would cover their short positions, and the cycle would repeat. But something has changed. The physical buyers have become so numerous and so persistent that the paper market is losing its ability to suppress prices for extended periods. When paper prices drop, physical premiums spike. Dealers run out of inventory. Delivery delays extend. The market is telling us that the paper price and the physical reality are diverging. You're probably wondering what this means for your portfolio, for your retirement savings, for your financial security. Let me be direct about this, because I think it's important to understand the implications. If you're sitting on significant retirement savings, let's say $100,000 or more in traditional retirement accounts, you might want to understand how gold IRAs work. I've put together a comprehensive guide that covers exactly how you can get physical gold into your retirement account without triggering tax penalties. It's in the description below. It walks through the process, the rules, the custodians, everything you need to know. Worth checking out if that's relevant to your situation. But beyond just the mechanics of how to buy gold, I want you to understand why this moment is different from previous cycles. Because that's what's going to determine whether you take action or whether you wait and potentially miss this window. Think back to 1971. That's when Nixon closed the gold window, ending the direct convertibility of dollars to gold. In the years that followed, gold went from $35 an ounce to over $800 an ounce. But here's what most people don't realize. The biggest gains didn't happen immediately. They happened after a period where gold consolidated, where skeptics said the rally was over, where people who bought early started to doubt their decision. The investors who made life-changing returns weren't the ones who bought at $35 and sold at $100. They were the ones who bought at $100, held through $150 and sold at $600 or $700. They were the ones who understood that the fundamental driver, the loss of confidence in fiat currency, was a multi-year trend, not a one-time event. We're in a similar moment now. The fundamental drivers are even stronger than they were in the 1970s. The debt levels are higher. The money printing has been more aggressive. The geopolitical tensions are more complex. But we're still in the early stages of this transition. Let me give you some specific numbers to illustrate what I mean. Total global debt is now over $300 trillion. That's more than 3 times global GDP. The interest payments on that debt are becoming unsustainable for many countries. The only way to manage that debt burden is through some combination of default, austerity, or inflation. Historically, governments always choose inflation because it's the politically easiest path. But here's the thing about inflation. It's not just about consumer prices going up. It's about the purchasing power of your savings declining. If you have $500,000 in a retirement account earning 4% interest, but real inflation is running at 6% or 7%, you're losing purchasing power every single year. Your account balance might be growing in nominal terms, but in real terms, in terms of what that money can actually buy, you're getting poorer. Gold and silver don't pay interest. They don't generate cash flow, but they maintain purchasing power over time. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought 100 years ago. Can you say the same thing about dollars? About any fiat currency? Now let's talk about what's happening with the BRICS nations, because this is a development that's flying under the radar for most Western investors, but it's going to have profound implications for precious metals prices. BRICS, Brazil, Russia, India, China, South Africa, these countries represent about 40% of the world's population and a growing share of global GDP. They've been working on mechanisms to trade with each other in their own currencies, bypassing the dollar. They've been accumulating gold reserves. They've been building alternative payment systems. Why does this matter? Because the dollar's status as the global reserve currency has given the United States enormous economic advantages. It's allowed the U.S. to run massive trade deficits, to print money without immediate inflationary consequences, to impose financial sanctions as a foreign policy tool. But that system only works as long as the rest of the world is willing to hold dollars and use dollars for international trade. If even a fraction of international trade shifts away from dollars, the implications are staggering. All those dollars that are currently held overseas, in central bank reserves, in corporate treasuries, in sovereign wealth funds, some portion of those dollars would flow back to the United States. That's inherently inflationary. And when countries and institutions lose confidence in the dollar as a store of value, they look for alternatives. Gold is the obvious alternative, because it's the one asset that's not anyone else's liability. China has been particularly strategic about this. They've been accumulating gold for years, but they don't report their full holdings. Analysts estimate that China's actual gold reserves are significantly higher than their official numbers. Why would they underreport? Because if they announced their true holdings, it would signal their intentions too clearly. It would drive up the price of gold before they've finished accumulating. But here's what we can observe. China has been importing massive amounts of gold through Hong Kong and Shanghai. They've built a domestic gold market that rivals London and New York. They've encouraged their citizens to buy gold. They've integrated gold into their financial system in ways that suggest they're preparing for a future where gold plays a more central role in international finance. Russia has taken an even more direct approach. After facing Western sanctions, Russia dramatically increased its gold reserves and reduced its dollar holdings. They've made it clear that they view gold as a strategic asset, a way to insulate their economy from Western financial pressure. Other countries watching this are drawing their own conclusions about the wisdom of holding all their reserves and assets that can be frozen or sanctioned. This is the geopolitical backdrop that's driving central bank gold purchases. It's not about investment returns. It's about financial sovereignty. It's about having assets that can't be devalued by another country's monetary policy or frozen by another country's political decisions. Now, let's bring this back to the individual investor level, because these macro trends have very real implications for personal wealth. If you're in your 50s or 60s, approaching retirement or already retired, you've probably spent decades building your nest egg. You've saved diligently, invested in your 401k, maybe built up some equity in your home. You've done everything right according to conventional financial wisdom. But that conventional wisdom was built for a different era, an era of relatively stable currencies, relatively low debt levels, relatively predictable inflation. We're not in that era anymore. The rules have changed, but most financial advisors are still operating with the old playbook. They'll tell you to have a 60-40 portfolio, 60% stocks, 40% bonds. They'll tell you that gold is a barbarous relic, that it doesn't generate cash flow, that it's too volatile. But here's what they're not telling you. Bonds have gotten destroyed over the past few years as interest rates rose. The traditional 60-40 portfolio had one of its worst years in recent history. Meanwhile, gold has been making new all-time highs. The barbarous relic has been outperforming the sophisticated financial instruments that were supposed to protect your wealth. I'm not saying you should put your entire portfolio into gold and silver. That would be reckless. But I am saying that having zero exposure to precious metals in this environment is a bet that the current monetary system is sustainable, that debt levels don't matter, that central banks can print unlimited amounts of money without consequences. That's a bet I wouldn't want to make with my retirement savings. Let's talk about the mechanics of what happens when this situation reaches a critical point, because I think understanding the potential scenarios helps clarify why positioning yourself now matters. Scenario 1. Gradual repricing. In this scenario, gold and silver steadily appreciate over years as more investors and institutions recognize the fundamental imbalances in the financial system. This is the soft landing version where the transition happens slowly enough that markets can adjust without major disruptions. Gold might go from current levels to significantly higher over a 5 to 10 year period. Silver, with its smaller market and industrial demand, could see even more dramatic gains. Scenario 2. Currency crisis. In this scenario, confidence in one or more major currencies breaks down rapidly. Maybe it starts with a smaller country, but the contagion spreads. People rush to convert their currency holdings into hard assets. Gold and silver prices spike dramatically in a short period. This is what happened in Weimar Germany, in Zimbabwe, in Venezuela. It's what happens when people lose faith in paper money. Scenario 3. Financial system stress. In this scenario, there's a major disruption in the banking system or the bond market. Maybe a large institution fails. Maybe there's a sovereign debt crisis. The government and central bank respond with massive monetary intervention, bailouts, quantitative easing, whatever it takes to prevent collapse. That flood of new money creation drives investors into hard assets as a hedge against debasement. Now, I can't tell you which scenario will play out or when. Nobody can. But here's what I can tell you. In all three scenarios, having exposure to physical precious metals before the crisis hits is vastly better than trying to acquire them during the crisis. During the early days of the pandemic, when people suddenly wanted physical gold and silver, premiums spiked to 30%, 40%, even 50% over spot prices. Dealers were sold out. Delivery times stretched to months. If you waited until the crisis was obvious to everyone, you paid a massive premium or couldn't get metal at all. That's why the title of this video is "The Sale is Over." I'm not saying prices can't temporarily pull back. Markets are volatile. There will be ups and downs. But the structural factors that have kept precious metals relatively affordable compared to the scale of monetary expansion, those factors are eroding. The paper market's ability to suppress prices is diminishing as physical demand overwhelms available supply. Central banks are removing supply from the market permanently. Industrial demand for silver is growing. Geopolitical tensions are driving diversification away from dollar assets. These aren't temporary factors that will reverse next quarter. Let me share one more story that I think illustrates the psychology of what's happening. There's a concept in behavioral economics called normalcy bias. It's the tendency for people to believe that things will continue functioning the way they always have, even in the face of evidence that circumstances have changed. In the lead-up to the 2008 financial crisis, there were warning signs everywhere. Housing prices had become detached from fundamentals. Lending standards had collapsed. Derivatives exposure was off the charts. But most people, including many sophisticated investors, didn't take action because they couldn't imagine that the system could actually break. They had normalcy bias. The people who protected their wealth in 2008 weren't necessarily smarter or better informed. They were the ones who took the warning signs seriously and positioned themselves defensively before the crisis became obvious to everyone. We're in a similar moment now with the monetary system. The warning signs are everywhere. Debt levels that can't be sustained. Central banks trapped between inflation and recession. Geopolitical fragmentation. Currency debasement. But most people have normalcy bias. They can't imagine that the dollar could lose its reserve status, that inflation could become persistent, that the financial system could face serious stress. The investors who will preserve and grow their wealth through the next decade will be the ones who recognize that we're in a different environment, that the old rules don't apply, and that positioning yourself before the crisis is obvious to everyone is the key to success. So what does this mean practically? It means understanding that precious metals aren't just an investment, they're insurance. They're a hedge against the scenarios we've discussed. They're a way to preserve purchasing power when paper assets are being devalued. It means recognizing that the periodic pullbacks in gold and silver prices, the sales that have created buying opportunities over the past few years, those are becoming less frequent and less pronounced as physical demand absorbs available supply. It means understanding that the gap between paper prices and physical availability is a warning sign, not a buying opportunity for paper instruments. If you're going to own precious metals, own the physical metal or instruments that give you direct claim to allocated, segregated physical metal. It means looking at your overall portfolio and asking yourself, am I positioned for the world as it is or for the world as it used to be? Because if your portfolio is built on the assumption that the monetary system of the past 50 years will continue unchanged for the next 50 years, you're taking an enormous risk. The central banks know this. That's why they're accumulating gold at record pace. The ultra-wealthy know this. That's why family offices and sovereign wealth funds are increasing their precious metals allocations. The question is, do you know this? And more importantly, are you going to act on it? The sale on precious metals isn't just ending. It's already over for those who understand what's happening. The institutions that create money are buying. The countries that control vast resources are buying. The investors who preserved wealth through previous crises are buying. The only question that matters now is, are you going to join them while there's still time, or are you going to wait until the crisis is obvious to everyone and pay whatever price is necessary to get protection? Because here's the thing about insurance. It only works if you buy it before you need it. Once your house is on fire, nobody will sell you fire insurance. Once the monetary crisis is obvious to everyone, precious metals will be priced accordingly. The opportunity to position yourself at reasonable prices will be gone. This isn't about fear. It's about prudence. It's about recognizing that the financial landscape has changed and adapting your strategy accordingly. The investors who thrive in the coming years won't be the ones who made the most aggressive bets or took the biggest risks. They'll be the ones who recognized the environment they were operating in and positioned themselves appropriately. The sale is over. The question is, what are you going to do about it?